Imagine you are looking at two identical index funds. I mean, they track the exact same sector, they have the exact same rock bottom expense ratios, and they even hold, essentially the exact same 30 mega cap technology companies.
Right. On paper, they look like twins.
Exactly, twins. But over the course of a single year, one of these funds makes you 20% richer than the other.
Which is just a massive anomaly.
Right. It blows my mind. And that is exactly what is happening in the $1 trillion artificial intelligence chip market right now. The reason why is hiding deep in the architectural fine print. So welcome to the deep dive.
Yeah, glad to be here to tear into this.
We are framing the session today as an exclusive, high-level strategy briefing designed specifically for institutional portfolio managers or, frankly, anyone managing their own capital who wants to start looking at the markets through an institutional lens. The overarching topic today is the 2026 semiconductor supercycle.
And it really is a supercycle.
Oh, absolutely. We're talking about a market that is quite literally blasting toward a historic $1 trillion in annual revenue.
It is a staggering milestone, for sure. But, the surface level numbers don't tell the whole story.
No, they never do.
Right. The sheer velocity of this capital deployment is creating massive structural fractures beneath the surface.
Which is exactly why we need to make sense of it all by synthesizing a massive stack of 2026 institutional intelligence.
We've got a lot to get through.
We really do. We are pulling from Deloitte's 2026 Global Semiconductor Industry Outlook and KPMG's latest survey of 151 top semiconductor executives.
Then we also have that deep dive flash research report on the SOXX ETF.
Right, the SOXX ETF, plus technical analysis from the PAMM trader and some highly critical market commentary from the Motley Fool and various ETF analysts on YouTube.
It's a very robust stack of data.
It is. And all of this data points toward a central mystery, basically a massive anomaly that completely defined the 2026 trading year. So the mission of this deep dive is to pull back the curtain on why ETF structure matters just as much as stock picking.
Because it really does.
It does. Because if you are looking at your portfolio right now and you bet on semiconductors, you might be thrilled, or you might be wondering why you left a massive pile of money on the table.
Yeah, let's look at the actual numbers here.
Let's do it. So the iShares Semiconductor ETF, ticker symbol SOXX, is up a jaw-dropping 89% year to date.
Incredible run.
Unbelievable. But its nearly identical twin, the VanEck Semiconductor ETF, ticker SMH, is up 68%.
So that's a 20% performance gap between two funds that track the exact same core sector.
Right.
And I mean, that is almost unheard of in modern passive indexing.
It really is.
Normally, when you are dealing with sector-specific ETFs, the variance is maybe 1 or 2%, and that's usually just driven by slight differences in rebalancing schedules or maybe a little cash drag.
A 20% divergence is basically a neon warning sign that something fundamental is different in the plumbing.
Okay, let's unpack this, because this is where the sheer scale of the 2026 chip market just violently collides with the mechanical reality of how institutions actually invest in it.
Yeah, I love that phrasing, the mechanical reality.
Because we are looking at a market expanding toward $1.6 trillion by 2030. I mean, it's driven by this unstoppable, insatiable demand for AI infrastructure.
Yeah.
But how you capture that growth apparently changes everything.
It changes your entire return profile.
Right. So both of these funds charge you a 0.34% expense ratio. Both hold the absolute giants of U.S.-listed silicon. I'm looking at the holdings right now, and they're essentially mirrors of each other at first glance.
At first glance, yeah.
So how in the world does a 20% divergence actually happen in the real world, like structurally?
What's fascinating here is the hidden mechanics driving this divergence. It fundamentally comes down to how the funds weigh the companies they hold.
The weighting, right?
Yeah, it isn't about what they own, it is about how much of it they are legally allowed to own.
Okay, break that down for me.
So SMH, the VanEck fund, is heavily market cap weighted. That means the bigger a company gets in the open market, the more of the fund's total assets it just consumes.
It just eats up the fund.
Exactly. And because of the incredible historic run Nvidia has had, hitting that massive $4.7 trillion market cap SMH is entirely dominated by them.
Right. They are a behemoth.
Yeah. Depending on the day's trading, Nvidia sits at roughly 16% to 18% of the entire SMH fund.
Wow. So SMH isn't really a diversified semiconductor fund anymore.
Not at all.
It is basically an Nvidia proxy with, some friends tagging along for the ride.
That's a perfect way to put it. If Nvidia announces a massive earnings beat, SMH soars. But if Nvidia has, a supply chain hiccup, SMH crashes.
That is the harsh reality of pure market cap weighting in a totally top-heavy market,
Right. But then you pull back the curtain on the SOXX methodology.
which is totally different.
Completely. SOXX tracks the NYSE Semiconductor Index, which consists of 30 U.S. listed companies. But they don't just let the winners run infinitely like SMH does.
Okay, so what do?
They use a modified float-adjusted market cap weighting with a very specific, incredibly strict rule embedded right in its prospectus. It's called the 8% structural capping rule.
Oh, I love this rule. I always compare it to a sports team with a strict salary cap.
Yes, that is the perfect analogy.
Think about it this way, right? If you look at SMH, they are spending all their payroll on one superstar quarterback, Nvidia.
Which works great if he's throwing touchdowns.
Exactly. If that quarterback throws 5 touchdowns, you win the Super Bowl. But if he gets sacked and twists an ankle, your entire franchise collapses.
Because you have no depth.
Right, because the rest of the roster is filled with minimum wage backups. But SOXX has this 8% salary cap that legally forces it to build a deep, diversified roster.
That is exactly how to understand it. At their quarterly rebalance, the top 5 holdings in SOXX are strictly capped at 8%.
And what about the rest of the index?
The remaining 25 companies in the fund are capped at 4%. They literally cannot spend more than 8% of their capital on the superstar quarterback.
So what actually happens mechanically on that rebalancing day? Like, say, Nvidia grows to 15% of the fund's value because the stock just went on a tear.
Yeah.
What does the portfolio manager at BlackRock actually have to do?
On the day of the quarterly rebalance, they are forced to sell the winner. They have to liquidate that excess Nvidia stock to bring its weight back down to that 8% ceiling.
They are forced to trim their best position.
Exactly. Because Nvidia is artificially capped, it usually just drifts around 7.5% to 7.9% in SOXX between those rebalances. But here is the critical part, what they do with the cash they just generated from selling Nvidia.
Right, that money has to go somewhere.
The fund is forced to take all that extra capital and distribute it down the line to the other names in the index to bring them up to their respective 8% or 4% weights.
So it artificially injects outsized capital into the rest of the sector.
Yes. And that leads us to the Micron anomaly.
Oh, this part is wild.
This absolute anomaly blew my mind when I was reading through the Motley Fool and the ETF analyst commentary. Because of this 8% capping rule, during the summer of 2026, Nvidia wasn't even the largest holding in SOXX.
That is just so counterintuitive to anyone watching the market this year.
Right. Micron Technology ticker MU actually became the largest holding in the fund at 8.77%.
Unbelievable.
But Advanced Micro Devices, AMD, was right there with it above 8%. The undisputed king of AI, Nvidia, was sitting in third place.
Which tells you everything you need to know about the defining narrative of 2026.
It really does.
The 8% cap forced SOXX to perfectly capture the broadening of the AI cycle.
Oh, okay, let's talk about that broadening. Because, early on, this whole AI boom was just a GPU story. It was all about the processor.
So it was entirely the Nvidia show. If you were building a data center in 2023 or 2024, you were just desperately trying to secure Hopper GPUs.
Begging for them.
Literally. But in 2026, the cycle broadened out into the massive physical infrastructure needed to actually support those GPUs, specifically networking and memory.
Right, because the GPU can't work in a vacuum.
Exactly. You can have the fastest processor in the world, but if it can't talk to the other processors, or if it can't pull data fast enough from memory, that expensive GPU just sits there idle.
Which is a massive waste of capital.
By forcing diversification, SOXX caught the massive upside of companies like Micron and Broadcom, leaving the Nvidia-heavy SMH in the dust as the rest of the sector rallied.
So the strategic takeaway for you as an institutional manager or serious investor listening right now is that structure dictates outcome.
It absolutely does.
SOXX won 2026 not by picking a better stock, but by structurally diversifying away from the most obvious winner. It was a forced rotation into the broader AI infrastructure.
So we really need to explore exactly why those diversified sectors exploded this year. Why did memory and networking suddenly become the most valuable players on this capped sports team?
Let's bring in the Deloitte and KPMG data for that, because honestly, the numbers we are looking at are just staggering.
The scale is hard to comprehend.
It is. The global chip market is hitting that $975 billion to $1 trillion mark in 2026. That is a 26% acceleration from last year.
A 26% jump on a base of hundreds of billions.
Yeah, it's wild. KPMG surveyed 151 top executives, and 73% of them now cite AI as their top revenue driver.
Right. It has totally eclipsed cloud computing, and it has eclipsed mobile.
Completely.
But what institutional managers need to understand is that this is not a software bubble. This is not highly speculative hype based on, user clicks or app downloads.
Right, this is tangible.
Look at the wafer fabrication equipment spending, what the industry calls WFE. This is the capital expenditure on the massive, incredibly complex machines that actually print the chips.
And what are the numbers there?
According to the data, WFE spending hit $116 billion in 2025, and is climbing to $126 billion in 2026.
And just to give you, the listener, some context on what WFE actually means in the real world, we aren't talking about simple conveyor belts here.
Oh, not at all.
We're talking about extreme ultraviolet lithography machines from ASML that cost hundreds of millions of dollars each.
And you need 3 Boeing 747s just to ship one of them to a factory.
It's insane.
Precisely.
Yeah.
You do not spend $126 billion on manufacturing equipment unless you have ironclad multi-year demand lined up from hyperscalers.
Exactly.
This is a multi-year physical infrastructure build-out. It takes years to build a fab and install these machines.
Which brings us back to Micron sitting at 8.77% of SOXX. Why did memory become the star of 2026?
It comes down to the global HBM memory crunch.
Right. AI data centers are processing unimaginable amounts of data to train these large language models. If you have an incredibly fast Nvidia Blackwell processor, but standard, slow memory, well, the processor finishes its calculation in a nanosecond and then just sits there waiting for the next batch of data.
The industry calls it the memory wall.
The memory wall, it's a massive bottleneck. So the industry rapidly shifted to high bandwidth memory, specifically HBM3E and DDR5.
But we really need to explain mechanically why HBM is so disruptive to the supply chain. HBM isn't just a slightly faster chip. It is a 3D architectural marvel.
Yeah, the engineering is wild.
They're literally taking multiple memory dies, shaving them down until they are microscopic, and stacking them on top of each other like a skyscraper.
Wow.
Then they punch microscopic holes through all the layers, they call them, through silicon vias or TSVs to connect them.
That sounds incredibly difficult to manufacture.
It is notoriously difficult. The yields, meaning the percentage of chips that actually work without defects, are much lower than traditional memory.
Oh, so they're throwing away a lot of bad chips.
Exactly. Furthermore, producing one HBM stack consumes roughly 3 times the wafer capacity of standard memory.
That is a massive resource drain.
HBM is expected to become a $100 billion submarket by 2028, all on its own. But the systemic ripple effect of that shift is what caused the financial explosion for companies like Micron.
Walk us through that ripple effect.
Because memory is a highly cyclical, manufacturing-intensive product, companies had to retool their existing production lines. They took massive amounts of capacity away from consumer memory, the DRAM that goes into your laptop or your smartphone, and they dedicated it to HBM for data centers.
Wait, let me get this straight. They essentially artificially choked the supply of normal, everyday memory just to feed the AI data center beast.
Yes.
Wow.
And basic economics dictates what happens when supply plummets while baseline demand remains steady.
Prices absolutely skyrocket.
Exactly. Deloitte's report noted that consumer memory prices spiked 4x between September and November of 2025 alone.
4 times in a few months.
And they are projected to surge another 50% by mid-2026. There are some server memory configurations that jumped from $250 to $700 in a matter of months.
That is just wild pricing power.
And that extreme pricing power flows directly to the bottom line of memory producers, which is exactly why Micron's stock surged and why the SOXX ETF, with its forced diversification, captured that surge so efficiently.
It is the ultimate picks and shovels play. But it isn't just memory, right? Networking is the other half of this broadening story.
Absolutely.
Look at Broadcom, ticker AVGO, which represents about 7% of SOXX. They hold an estimated 80% of the AI Ethernet silicon market.
A total monopoly, basically.
Pretty much. They make something called the Tomahawk 6 switch, which enables 102.4 terabits per second of bandwidth. Now, what does 102.4 terabits actually mean for you listening?
It's a lot of data.
It's an ocean of data. When you are connecting 100,000 GPUs in a single massive AI data center, they all have to talk to each other instantly to train a model. If the network is slow, the entire $5 billion cluster is slow.
You're only as fast as your weakest link.
Exactly. Broadcom is providing the nervous system that allows all these individual GPU brains to operate as one giant supercomputer.
And the pricing power these networking and GPU companies have right now is historic. We are looking at hardware companies which traditionally have cyclical low to medium margins due to physical manufacturing costs operating with the financial profiles of elite software companies.
Yeah, the margins are where the institutional eyes really pop.
Nvidia is maintaining roughly 75% gross margins with its new Blackwell and Rubin platforms.
Insane.
And Broadcom sits at 77% gross margins.
77% gross margins on physical silicon? That is absurd. You usually only see that kind of margin on a SaaS company that just duplicates software code at basically zero marginal cost.
Right, not on something forged in a billion-dollar factory.
The Flash Research report actually called these companies category killers with unmatched moats.
Mhm.
Nvidia has its CUDA software ecosystem that basically locks developers in because they've spent a decade learning how to code on it.
It's a walled garden.
A very profitable one. And Broadcom has custom ASIC contracts with hyperscalers like Google and Meta, locking them in for years. It isn't a competitive free market right now. It is an infrastructure oligopoly.
If we connect this to the bigger picture, though,
Here comes the bear pushback. I knew it was coming.
we have to. We have to confront the reality that this entire $1 trillion house is built on a very specific, very fragile foundation. This is the high-stakes paradox of 2026.
Well, you look at 89% ETF returns and 77% gross margins, and the alarm bells start ringing for anyone with a contrarian bone in their body. But honestly, with margins that high and demand just wildly outstripping supply, how can you argue with the momentum?
You have to argue with it because of what the underlying data is screaming at us. When you look closely at the Deloitte report, there is a shocking statistic that exposes what we call the K-shaped paradox.
K-shaped, like a divergence.
Exactly. It highlights a terrifying divergence between unit volume and dollar value. In 2026, AI chips are generating $500 billion. That is half of all semiconductor industry revenue.
Right. Massive value creation. Half the industry's money comes from AI. That sounds like a pure bull thesis to me.
But look at the physical volume. Those AI chips represent less than 0.2% of total unit volume.
Wait, less than 1%.
Less than 0.2%. We're talking about roughly 20 million AI chips driving $500 billion in revenue out of 1.05 trillion total chips sold globally across all sectors.
Okay, but wait. Why does volume even matter if the margins are 77%? Like, who cares if they only sell 20 million chips if those are the only chips making actual astronomical profit? It's like Ferrari versus Honda. Ferrari sells a fraction of the cars but pulls in massive margins.
The Ferrari analogy works for cars, sure, but semiconductors are an integrated global ecosystem. The industry's revenue is entirely propped up by a microscopic fraction of its actual physical output.
So it's incredibly concentrated.
Exactly.
Yeah.
If that 0.2% hyper-concentrated demand suddenly normalizes, the entire revenue narrative of the semiconductor supercycle collapses.
Oh, I see what you mean.
What happens if hyperscalers like Amazon, Google, and Microsoft decide they have built enough AI capacity for the next 3 years? What if they just stop ordering those 20 million hyper-expensive chips to digest the infrastructure they've already built?
That is the trillion-dollar question. If they pause capital expenditures, the bottom falls out.
Exactly. Because the non-AI markets, PCs, smartphones, automotive chips, they're still relatively sluggish. Remember the memory price spikes we just talked about?
Right, the 4x jump.
That is actually hurting PC and smartphone manufacturers because their component costs are now too high. It's squeezing their margins and forcing them to raise prices on consumers, which cools demand even further.
It's a vicious cycle.
The entire semiconductor industry is currently dependent on hyperscaler AI infrastructure spending continuing at a breakneck, unyielding pace.
And that is just the demand side risk. The supply side is honestly what keeps portfolio managers awake at night. Let's talk about the geopolitical reality and the Taiwan choke point.
It is the ultimate geographic fragility in the history of modern economics. Over 90% of the world's most advanced chips are built in a single geopolitical hotspot, Taiwan, primarily by TSMC.
Which, by the way, represents roughly 4.4% of the SOXX ETF as a direct holding. But indirectly, TSMC manufactures the chips for Nvidia, AMD, and Broadcom. So the exposure is vastly higher than 4%.
The exposure is total.
Total.
And while the revenue is booming, the supply chain shocks are becoming severe and frequent. We've seen this with the Iran conflict recently.
Right.
When a geopolitical crisis hits, the market tends to focus on oil. But the semiconductor industry is highly sensitive to critical raw materials.
Like what?
For example, the price of tungsten, which is absolutely essential for creating the metal gates and interconnects within advanced semiconductor manufacturing, skyrocketed to $3,000 per metric ton unit due to these Middle Eastern supply chain shocks.
It's $3,000.
The ecosystem is stretched incredibly thin. There's zero slack in the system.
And that brings us to the absolute geopolitical elephant in the room that we just have to discuss, the MPCH Act of April 2026.
Yes, the Multilateral Alignment of Technology Controls on Hardware Act. This is a massive structural piece of the 2026 landscape that many retail investors are completely ignoring.
Well, let's bring them up to speed.
The NDTH Act introduces a total ban on exporting 3-nanometer and 2-nanometer EDA software to restricted entities.
Now, before we go any further into the mechanics of this, a crucial note for you listening. We are not taking a political stance on U.S.-China trade policy, nor are we endorsing these regulations. We are strictly analyzing the MTCH Act as an objective legislative event that institutional portfolio managers must price into their risk models regarding global revenue streams.
That neutrality is vital because from a pure risk modeling perspective, the MTCH Act is a profound shock to the system.
Definitely.
Let's explain what EDA software actually is. It stands for Electronic Design Automation. When companies like Nvidia or AMD design a 3-nanometer chip, they are laying out billions of microscopic transistors.
Right.
Human beings cannot draw this. They rely on AI-driven physics simulators provided by companies like Synopsys and Cadence to simulate whether the electrons will flow correctly or leak. Banning EDA software literally prevents a nation from designing advanced chips. You are forcing them to draw with crayons while the rest of the world uses AutoCAD.
And the MAPCH Act didn't just stop at software, right? It implemented a 20% tariff on Chinese-made legacy chips, the older, larger chips used in cars and basic electronics, and it requires strict end-user verification for all AI accelerators.
This forces companies in the SOXX ETF to fundamentally bifurcate their supply chains. The semiconductor equipment makers, companies like Applied Materials, Lam Research, and KLA Corporation, which make up a massive chunk of SOXX's diversified portfolio, rely heavily on global sales, including massive sales to China.
So they are exposed.
Very exposed. If they are abruptly and legally cut off from selling advanced lithography and metrology tools to certain regions, that is a permanent, irrecoverable loss of a massive revenue stream. Wall Street analysts have to instantly wipe that future cash flow from their discounted cash flow models.
Which accelerates this whole Foundry 2.0 movement we are seeing. Because of these geopolitical risks, everyone is trying to build domestic chip plants. The US, Europe, Japan, they all want their own fabs.
Which sounds phenomenal for national security and supply chain resilience.
But financially, it is an absolute margin killer. Let's talk about the capital intensity moat. Building a single leading-edge fab right now costs roughly $20 billion. $20 billion for one factory.
And that astronomical cost creates a massive capital intensity moat. It means only a strict oligopoly of companies, TSMC, Samsung, and Intel, can even afford to attempt it.
The barrier to entry is just too high for anyone else.
Exactly. But it also saddles those companies with staggering debt, massive depreciation schedules, and crushing overhead.
Yeah, just look at Intel.
Right. Intel is struggling mightily under the weight of this capital expenditure compared to fabless companies like Nvidia or AMD.
Because the fabless companies just design the chips, enjoy 75% gross margins, and let TSMC take on all the $20 billion manufacturing risks.
Exactly. So we have this massive, almost irreconcilable tension in the market.
We really do. On the bull side, you have a $1 trillion market, 77% gross margins, an ETF that is up 89% due to brilliant structural capping, and an AI infrastructure build-out that shows absolutely no signs of stopping.
And on bear side, you have a terrifying 0.2% volume paradox, extreme geographic fragility in Taiwan, $3,000 tungsten prices, and the MTCH Act threatening to permanently sever global revenue streams.
So if you are a portfolio manager staring at this data, what do? Let's follow the money and look at the institutional strategy and the technical realities of SOXX right now.
This is where the raw data from the market terminal gets really illuminating, because despite all the geopolitical risks, the fragile power grids, and the MPCH Act tariffs we just outlined in excruciating detail, institutional investors have made their choice.
And it is a loud choice.
They're betting heavily, almost aggressively, on the AI infrastructure thesis.
Heavy is a massive understatement. The institutional ownership of the SOXX ETF jumped 71% year-over-year to hit 53.1%.
Over half the fund.
Let that sink in. More than half of this massive ETF is now held by institutions. They grew their total dollar investment by 138% in a single quarter. We are talking about smart money pouring $10.9 billion of fresh capital into this specific ETF.
It's an avalanche of cash.
The Flash report explicitly calls this out. This is active, high-conviction buying. They aren't scared of the MTCH Act. They aren't paralyzed by the K-shaped paradox. They are buying every dip and riding the supercycle.
They are riding it, yes, But even the smart money leaves technical warning signs in their wake.
Okay, what do the charts say?
The PIM trader data provides a very sober mathematical look at the price action. Currently, SOXX holds a PIM score of 4.
Okay, and for those who don't use that metric.
Now, 4 means momentum is objectively strong, but it is not at a peak 5. There's underlying hesitation. The buyers are stepping in, but they're stepping in cautiously.
Which we saw incredibly clearly right in the middle of June.
Exactly. I want you to look at the sharp drop on June 16, 2026. The SOXX ETF fell 5.92% in a single trading session on massive, undeniable volume, 11.2 million shares traded.
Wow.
You don't see 11 million shares move on a 6% down day because retail investors got spooked.
No, that's not retail.
That is a heavy institutional distribution day. That is a major fund manager hitting the bid and liquidating a multi-billion-dollar position.
This raises an important question then.
It does. Is the market temporarily exhausted? Have we pulled forward too much future growth into the current price?
A 6% drop in a single day will definitely test your conviction. But let's look at the moving averages because that tells a story of tension.
The technical tension is palpable. The price of SOXX is currently hovering around 591 cents. That is dangerously close to the 10-day moving average of $583.61.
And if it breaks that?
Mechanically, if the price breaks below that short-term support line, algorithmic momentum traders usually hit the sell button, which can trigger a rapid cascade downward. However, zooming out, the price is still well above the 200-day moving average, which sits way down at $356.40.
So the long-term trend is undeniably ferociously up. But short-term, we are vulnerable to a nasty pullback.
That's the read.
But here is the thing, and I'll push back on the bearish technicals here. There is a massive structural safety net under this ETF that I don't think retail investors or even some PMs fully appreciate.
You're talking about the buybacks.
Yes, the top constituents in SOXX have built a massive buyback floor. Nvidia just announced they are returning $41.1 billion to shareholders through stock repurchases. Intel, despite their capex struggles, bought back a stake in their fab for $14.2 billion.
It's a huge defensive move.
Let's explain the mechanics of this. When these hardware companies are printing literal billions in free cash flow at 75% margins, they use that cash to buy their own stock on the open market and retire the shares.
And by shrinking the total number of shares outstanding, the denominator in the earnings per share equation shrinks.
So the EPS goes up.
Exactly.
Yeah.
So even if their net income stays completely flat, their earnings per share artificially goes up. This mathematically compresses their price-to-earnings ratio, making the stock look cheaper to algorithmic value screeners, which forces passive funds to buy more.
It is financial engineering functioning as a defensive moat.
Exactly. It creates a synthetic floor under the ETF's price. But for you, the listener, trying to navigate this exact entry point in 2026, there is a highly practical, tactical takeaway hidden in the BlackRock ecosystem.
Oh, this is a great point.
If you are thoroughly convinced of a long-term AI supercycle, but you are wary of the current price volatility and you want to optimize your fees, there's a cheaper sibling to SOXX.
Yes, SOXQ. This is a vital tactical nugget for portfolio construction. BlackRock offers SOXQ, which tracks the exact same NYSE Semiconductor Index. It has the exact same 30 holdings.
And most importantly, it enforces the exact same 8% structural capping rule that forced the brilliant diversification into Micron and Broadcom.
Right. But it does it with an expense ratio of 0.19%, essentially half the cost of SOXX.
So why wouldn't everyone just buy SOXQ and save the fee?
It comes down to market liquidity and trading mechanics. The institutional managers pouring in that $10.9 billion still vastly prefer the more expensive SOXX because of its massive daily trading volume and razor-thin bid-ask spreads.
Yeah, when you're moving size, that spread matters.
If you are moving $50 million of an ETF in a single block trade, a 1 penny difference in the bid-ask spread costs you significantly more money than a fraction of a percent in annual expense ratios. SOXX gives them frictionless entry and exit.
Right.
But if you are a listener where cost is the deciding factor for a 10 to 15-year buy-and-hold strategy in a tax-advantaged retirement account, SOXQ is mechanically identical and structurally superior due to the lower fee.
That's a great takeaway.
Okay, we have covered a tremendous amount of ground today. Let's bring this debate to a close and synthesize the core lesson for the portfolio managers and investors listening. The 2026 semiconductor supercycle isn't just about picking Nvidia anymore. That is the 2023 playbook.
The 8% capping rule in SOXX proves conclusively that structural ETF design matters immensely.
Structure is everything.
By legally forcing diversification into the broader AI infrastructure, into high-bandwidth memory giants like Micron, into networking oligopolies like Broadcom, and into the equipment makers, SOXX became the superior institutional strategy.
And the numbers prove it.
It generated an 89% return, outpacing the market cap-weighted SMH by a staggering 20%, despite massive geopolitical risks, the MTCH Act, and a key-shaped paradox of chip volume.
And looking ahead, the Flash Report's base case paints a picture of a $1.6 trillion industry by 2030. They have a long-term stabilization and growth marker for SOXX aiming toward a $580 target by 2031.
Okay, $580.
Now, given that the ETF is currently trading hot, right around that $562 to $591 range in mid-2026, it suggests we might be entering a period of massive consolidation.
The earnings basically have to catch up to these explosive forward multiples.
Exactly. The supercycle is real, the physical infrastructure is being built, but the easy money for multiple expansion might be in the rearview mirror.
Which leaves us with one final structural vulnerability to ponder, something drawn from the absolute periphery of our sources today, but something that could redefine the next 5 years.
Okay, lay it on us.
As these AI data center buildouts expand to support this $1 trillion chip market, they are violently colliding with the physical limits of our electric power grids.
The grid can't handle it.
You can manufacture the chips and you can buy the Broadcom switches, but you cannot simply plug a 1 gigawatt AI data center into a constrained municipal grid. The physical world is pushing back on the digital expansion.
It's a huge bottleneck.
Furthermore, there is a rising risk that analysts are just starting to whisper about in institutional circles: circular financing.
Circular financing. Let's unpack that before we go, because that sounds like a systemic risk.
It is. We are seeing early signs where AI model developers and infrastructure players essentially swap compute access for equity in each other's companies.
Wait, how does that work?
A hardware provider gives a startup $100 million worth of GPU compute time, and in exchange takes $100 million in startup equity.
Oh, wow.
It creates massive paper valuations and masks mounting tech debt without generating actual external cash flow from outside customers.
It's an incestuous loop of capital.
Exactly. So the final provocative question you have to ask yourself as an investor is this: if the global electric grid physically caps out and halts data center construction, or if the software side of AI fails to generate the massive downstream return on investment required to pay off these multi-billion-dollar hardware clusters in actual cash, will the 8% capping rule in a diversified ETF be enough to protect your portfolio from the fallout?
We started this deep dive talking about the expectation of precision in financial markets. But in the 2026 semiconductor supercycle, there are no clean lines.
None at all.
We are navigating incredibly complex, diagnostic, muddy waters where ETF structure, power grid limitations, geopolitical software bans, and 0.2% volume paradoxes ultimately decide your returns.
That's a lot to weigh.
It really is. Keep questioning the consensus, keep looking at the structural plumbing beneath the ticker symbol, and thank you for joining us on this deep dive.